Pfizer Stock, ticker symbol PFE. This stock is down almost 30% year to date, which is quite the difference with the S&P 500. On the 1st of August, Pfizer presented quarter results where they beat on EPS, but missed on revenue. Analysts think they will miss on their next target. People love Pfizer stock because of the dividends, and I understand why, with dividend yield at 4.5% and 12 years of dividend increases. So could this be the perfect moment to buy PFE stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Pfizer do? Pfizer develops and produces medicines and vaccines for immunology, oncology, cardiology, neurology. Pfizer is best known for the COVID vaccine, which played a huge role in the revenue increases of 2021 and 2022. When we dive in the most recent earnings result, we see some interesting things. Expected decline in Paxlovid and Cardiology revenues drove 53% operational decrease in revenue. Excluding contributions from these two, revenue grew 5%. Pfizer reported an EPS of $0.41 year over year, a decline of 77%. Pfizer also narrows 2023 revenue guidance range to 67 to 70 billion and adjusted 2023 non-COVID operational revenue growth expectations to 6 to 8%, and maintains all other components of the full year 2023 financial guidance. In here we see the revenue breakdown. In total, the revenue declined 54% year over year as mentioned before. Primary care is by far the biggest segment and decreased more than 72%. Specialty care is the only segment that is capable of growing right now, sitting at 9% year over year. A thing that I think is very interesting is the potential non-COVID revenue that will be invested. Pfizer sees a potential of 84 billion in revenue in 2030. Of course, we need to take this with a grain of salt, but it is an interesting approach. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Pfizer is a 203 billion market cap company. PE ratio is at 9.5, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for Pfizer stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 77 billion and in this graph we see that revenue went down until COVID came. Revenue skyrocketed, but most recently revenue is coming down big time, so that's something to keep your eye on. Over a longer period of time, margins are increasing, which is a good thing. EPS is following the same pattern as the margins, so nothing special here. Analysts expect 2023 to be a rough year for Pfizer in terms of EPS growth. After 2023, it's expected to see low to mid single digit growth. For the revenue, it is a pretty similar pattern, but with slightly lower numbers. It is expected to see low single-digit growth in the coming years. Return on assets is sitting at 8.4%, which is a decent number. Return on equity looks really good at 22%. And the most important number, return on invested capital, is sitting at 9.8%, which is a great number. It is slightly higher versus the 5-year average, which is also nice. Current ratio is at 2.12, which is looking pretty good. It is going down in the long run, which is not a bad thing. Right now, Pfizer has 65 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash position. Pfizer has 44 billion in total cash, so they can pay down a big chunk of their debt, which comforts me a lot. But it is still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down in the long run. But most recently it is going up, which might be not sustainable for the future, so keep that in mind. Shares outstanding are decreasing, which is a good thing. But there were some quarters with increases in shares outstanding most recently, which I don't like, of course. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 4.5%, which is a great number. Annual payout is at $1.64 and payout ratio is at 33%. I prefer 50% or lower, so right now they have 67% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 5%, which is not the highest number to be honest, but they increased the dividends for 12 years in a row, which is kinda nice. And if you take a look at these numbers, the dividends paid since 2012, you see that Pfizer is increasing the dividends at mid-single digits on average. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that over a longer period of time, payout ratio is decreasing. Most recently it increased a little bit, but nothing that worries me. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at historical growth numbers, which is a little bit disappointing to me. But overall these dividends look pretty good to me. But how about the historical returns? I decided to compare Pfizer stock with the overall market. In this case the S&P 500. Next to that I added two competitors, Novartis and AstraZeneca. On the 5-year chart we see that Pfizer was beaten by the S&P 500 by quite a margin. In total, Pfizer returned 10% including dividends, versus the S&P 500 sitting at 68%. AstraZeneca is the only stock to beat the S&P 500. On the 1-year chart it looks pretty different, with the S&P 500 returning 13% including dividends, versus Pfizer returning minus 18% including dividends. NVS had the highest return with 31%. On the 6-month chart it is a pretty similar story, with NVS having the highest return, while Pfizer again was beaten by the S&P 500. On the 1-month chart it is finally Pfizer that beats the others in this list. So bottom line, Pfizer stock was beaten by both the S&P 500 and competitors on the 5-year chart. So could this be the perfect time to buy Pfizer stock? Well, let's check the 3 price tags that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 0, 2 and 4%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 27, 28 and 29%, and for the free cash flow margin I'm putting in the same numbers. For the PE ratio and the price to free cash flow I'm putting in 12, 13 and 14. There is not a lot of growth left, especially if we check historical performance, so that is why I want to pay a lower multiple. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now Pfizer stock is at $36. I hit analyze and we see a few green numbers. We have a low price target of $32, which is a decent drop from the current stock price. We have a mid price target of $40 and we have a high price target of $49. To me, the low to mid price target is the most justified here, indicating that this stock is in the middle of this price target. And to be honest, I'm leaning a bit more to the lower side here. My final conclusion on this stock is that I do like the business. It is a massive company that pays a solid dividend, but there is not much growth for the future in terms of revenue, free cash flow and dividends. From a value point of view, things don't look too bad, to be honest. But the lack of growth is really holding me back on this one. For now I'm skipping this stock since I feel that there are better deals out there. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.